Yes, Tyler, 261,000, a 19-month high. Look at the 2s and 10s chart. Boy, they dropped rather quickly. And today we have a really special guest, Jerome Schneider, Managing Director of PIMCO. Jerome, let's get right into it. You saw the data this morning. You saw the market move. Give me your impression. What really caught my eye is we dipped below 50% on that move with respect to the July meeting.
Yeah, we basically are undulating between the expectations of real-time data and the expectations that inflation is going to stay stickier for longer. This is going to be a consistent theme for a good period of time. We call it the aftershock economy at PIMCO, but really what we're thinking about is the fact that we are dealing with the long-term challenges of the economy, the forecast of a likely recession, coupled with an evolving economic landscape. Profitabilities are in question, and more importantly, systemic liquidity is going to be in flux over the next 6 months or so.
Now, correct me if I'm wrong, but these are topics we've been talking about a lot. So really, it's refocused due to the bill bomb, T-bills. Yeah. How many T-bills are going to be falling from Janet Yellen? 1 to 1.5 trillion?
1.1 trillion over the next few months.
And where's it going to come from?
In reality, we're going to see that the digestion this week has actually been pretty well. It's been pretty well digested.
Super well.
Great news. But we actually have issuance out the curve. We have other things to consider. And so over time, the fundamental question is, how do we digest these T-bills, given money market funds are robust at this point in time, but largely investing their cash in the reverse repo facility still near all-time records? This in and of itself is a drain on liquidity. We're going to have excess reserves decrease, and when we look out the time schedule, we actually have to think about where this liquidity goes. There's a crowding out effect for cash.
Now, correct me if I'm wrong, though. Listen, that 1.5 trillion is a lot of T-bills, and the Treasury General Fund is what, under 50 billion. I get it. However, has there been anything going on the last 3 weeks that hasn't involved this conversation by market players? Is it really going to be all that shocking? Have we taken some of the sting out of it, in your opinion?
Well, the sting immediately has been, we've been very good in communicating that the T-bill issuance is going to be large. So the shock effect is gone. However, the ongoing effect of how it's going to be digested is the factor. We have to think about, most importantly, some of the shocks we saw back in March. Bank effects, funding with banks. And there's going to be effectively a rationalization of bank funding where we
now the market knows that now. And think about next week's calendar, okay? You have the bills you're talking about, QT resumption. They basically kind of stopped QT. You have CPI coming out, and you have the Fed meeting, and you have VIX at what? A 3.5-year low.
Right. The VIX is obviously a very large sounding point with regard to the economy. It's a little bit sanguine. In reality, we need to be preparing for a little bit more volatility in the market, whether it's from the economic outlook, whether
it's from
money
supply?
Monetary supply, money supply, just liquidity in general. So portfolios, clients need to be thinking about how to utilize a diversified portfolio to manage volatility given this low volatility state. And probably won't be here for long.
Real quickly now, we have 30 seconds left. Negative 0.1% Q4 and Q1, the European Union, they are, in my opinion, in a recession. Your thoughts on that? We have to close it up.
Yeah, basically we're going to see uneven growth across the economies. We saw the Bank of Canada.
It's certainly not going to help our global economy, is it?
It won't, and just emulates volatility that is going to be persistent throughout the global marketplace. And we have to be prepared for that by being balanced in that result.
Excellent. So, Jerome, you want to be cautious, but it doesn't mean you can't plan what you're going to trade and trade your plan.
Exactly. Be cautious, but also understand that in this world of lower volatility, recognize the fact that there's a lot of income that's out there and utilize that as a counterbalance to risk assets.
Jerome Schneider of PIMCO, thank you. Kelly, Tyler, back to you.